Imagine this. You're lying in bed at 2 a.m. Your phone buzzes. You glance at the glowing screen, and there it is. A push notification telling you your favorite stock just spiked, or that a coin you casually bought has doubled overnight. Suddenly, you're wide awake. Your heart races. You tap open your trading app and start scrolling. You tell yourself it's just a quick check. But 45 minutes later, you're still staring at candlestick charts, reading Reddit threads, refreshing price feeds. Sound familiar? Here's the uncomfortable truth. This isn't just your lack of discipline. This is deliberate design. Billion-dollar companies engineer their financial products to trigger the same psychological responses that keep gamblers glued to slot machines and teenagers hooked on TikTok. And the most dangerous part? It works on everyone. From casual investors checking crypto prices, to seasoned traders on Wall Street, to retirees convinced that a shiny new safe product will protect their savings. Today, we're going to pull back the curtain on the 10 psychological triggers that make financial products addictive. By the end of this journey, you'll see exactly why your brain craves market volatility, why you're drawn to high-risk products you don't even understand, and why seemingly rational people keep losing money while thinking they're in control. Let's begin with the spark that lights the fire. Level 1. Curiosity spark. Everything begins with curiosity. Our brains are hardwired to notice what feels off, what challenges expectations, what doesn't fit the pattern. And smart companies know this. When Robinhood launched in 2013 with its revolutionary promise of commission-free trading, it shattered a belief that had existed for decades, that you had to pay fees to brokers to buy and sell stocks. This was the accepted cost of entry, baked into the system. Suddenly, here came a bright, clean, millennial-friendly app saying, "No fees, trade for free." The confusion was the hook. Your brain starts firing questions. How can they afford this? What's the catch? Is this a scam? But curiosity is so powerful, you download the app just to find out. This isn't random. Psychologists call this the information gap theory. When we encounter something surprising that creates a gap between what we know and what we don't, our brains become obsessed with closing that gap. And that obsession drives behavior, like millions of downloads. It's the same strategy behind teaser financial products, 0% credit cards, introductory interest rates, cryptos with mysterious names like Dogecoin. They confuse you just enough to spark curiosity, and that curiosity becomes the first step into the rabbit hole. Level 2. Scarcity power. But once they have your attention, they need to create urgency. Enter scarcity. Scarcity is one of the most powerful psychological levers because it taps directly into our evolutionary survival instincts. For our ancestors, scarce meant valuable. Food, water, safe shelter. Our brains are still wired to overreact to anything that feels limited. Take Bitcoin. The legendary 21 million coin cap is repeated so often, it has become scripture for crypto believers. Scarcity is the entire value proposition. The marketing narrative is simple. Only 21 million will ever exist. Better grab some before it's too late. But it's not just crypto. The luxury real estate market thrives on this principle. Why does a Manhattan penthouse sell for $50 million? Not just because of square footage, but because there are only a handful of them in existence. Same with beachfront Dubai villas or private islands in the Bahamas. Scarcity itself inflates the price. Studies in behavioral economics show that people are far more motivated by the possibility of losing out than by the chance of gaining more. This is called loss aversion. Financial products exploit this relentlessly, whether it's limited IPO allocations, exclusive hedge funds, or apps flashing "only 3 spots left" in bold red. Scarcity isn't just a feature, it's a weapon. Level 3. Social proof. Humans are tribal. For thousands of years, survival meant sticking with the group. That ancient instinct still drives us today, only now it manifests in financial markets. This is social proof, the psychological shortcut where we assume something must be good if lots of other people are doing it. And in the age of social media, this trigger has never been more powerful. Look at Tesla stock. For years, analysts screamed it was overvalued. But Elon Musk's massive Twitter presence combined with Reddit forums like Wall Street Bets created a feedback loop. People didn't just buy Tesla because they analyzed earnings reports. They bought because other people were buying, talking about buying, and bragging about getting rich by buying. Every screenshot of profits posted online acted as proof to the next investor. Every viral meme fueled the fire. Social proof turned Tesla into a cultural movement, not just a company stock. And this isn't new. The dot-com bubble was pure social proof mania. In 1999, if a company added .com to its name, the stock price skyrocketed, regardless of whether it had a real business. Everyone else was buying, so people piled in. convinced they couldn't all be wrong. It's the same instinct that drives herd behavior in crypto, meme stocks like GameStop, or even financial influencers selling courses. Social proof whispers to your brain, if everyone else is doing it, it must be right, and your wallet follows. Level 4. The dopamine hit. Now we get to the heart of addiction. Dopamine. Modern financial platforms are not just trading tools, they're behavioral casinos. Every push notification, every green arrow flashing upward, every trade confirmation with animations is carefully engineered to trigger your brain's reward system. Robinhood's confetti celebrations when you executed a trade weren't a quirky design choice. They were pulled directly from the playbooks of casinos and mobile gaming apps. Coinbase sends alerts only when volatility is high, because they know uncertainty drives emotional spikes. Binance uses sound effects and vibrant color changes to heighten the drama of price swings. Each micro-reward trains your brain to crave more. You don't just trade to invest, you trade to feel. Level 5. Habit formation. Finally, the products that win long-term aren't the ones that give you a single dopamine rush. They're the ones that embed themselves into your daily life until they become automatic habits. Amazon Prime is the perfect case study. What began as a perk for free shipping has now rewired millions of people to default to Amazon for nearly every purchase. Prime turned shopping from an occasional decision into an unconscious reflex. The same psychology now drives financial apps. Cash App and Venmo don't just make money transfers easy, they normalize checking balances daily. Acorns doesn't just help you invest, it automates the process so you're investing without even thinking about it. Recurring crypto buys on Coinbase transform a volatile gamble into a quiet daily habit, disguised as dollar cost averaging. Level 6. Mainstream adoption. This is the tipping point. At level 6, the disruptor crosses into the mainstream. Suddenly, it's not just techies, niche users, or early adopters. It's everyone. Your grandparents use Netflix. Your parents are ordering groceries online. Uber isn't a quirky San Francisco app anymore. It's how people commute in hundreds of cities worldwide. At this stage, the company has achieved what every entrepreneur dreams of, crossing the chasm. Geoffrey Moore famously described this as the most dangerous leap, moving from early adopters who forgive imperfections to the mainstream market, which demands reliability, scalability, and trust. Level 7. Market redefinition. Now comes the real shakeup. At level 7, the disruptor isn't just competing, it's redefining the market itself. They shift the rules of the game, forcing incumbents to play on their turf. Look at Amazon. It wasn't just another bookstore, it became the everything store. Apple didn't just make better phones, it created the App Store economy, changing not just how we use phones, but how entire industries like music, software, and payments operate. Uber didn't just disrupt taxis, it opened the door to food delivery, freight, and even gig work economies. Level 8. Resistance and regulation. Every revolution invites resistance, and by level 8, disruption runs headfirst into backlash. Governments, regulators, lobbyists, and sometimes even the public push back. Uber faced lawsuits, bans, and strikes. Facebook faced hearings over privacy, misinformation, and monopolistic practices. Cryptocurrency exchanges are constantly under the microscope of financial regulators. Even Airbnb has been attacked for driving up housing costs in cities. Level 9. Global domination. At level 9, the company isn't just an industry player, it's a global force. This is when disruption becomes planetary. Netflix is now in over 190 countries, shaping global culture. Amazon has reshaped retail across continents. Apple redefined luxury technology, influencing billions of people. Disruptors at this stage are not just companies, they're ecosystems. They control supply chains, dominate markets, and sometimes even influence geopolitics. Level 10. Permanent transformation. Finally, we arrive at the ultimate stage, permanent transformation. This is when disruption is no longer the new thing. It is the thing. It's not disruption anymore. It's the status quo. Streaming is now the default. Online shopping is the default. Ride-hailing, mobile payments, smartphones, AI-driven recommendations. These were once radical disruptions. Now, they're invisible infrastructure. The once disruptive company has become the very fabric of daily life. So, when you think about disruption, don't just think about a startup or a product. Think about these 10 levels. If you want to see the bigger picture and make smarter decisions in a world shaped by disruption, make sure to subscribe and join us on Econ Fix Explained, your guide to how money, markets, and ideas move the world.